This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. I had a crank come at me the other day, or perhaps we should call him a troll, or perhaps just an asshole. The guy titles his email, subject heading, "I'm a fan." Then proceeds to ask me all of these, just ass-kissing questions. And then quickly turns it around and starts making all these accusations. Covel's this, Covel's that, Covel doesn't do this. You know, just typical troll shit. But it really got me thinking. Here's a guy who says he wants to know something about trend following. Now, for all I know, he's probably just a competitor pushing some other type of strategy. That's generally how these things roll. But let's say he really did want to understand trend following. I was thinking to myself, even if I was dead, I'm not here anymore. And you've got all the content from my hard drives concerning trend following. The vast array of documents, library-esque, much of it not public. So I'm dead. And you have access to all this information. So you can no longer make personal accusations and say that Mike Covel's a bad guy, he's this, he's that. All that other kind of stuff is nonsense. That doesn't make a hill of beans difference. But now you've just got the content. Now, can a maniac guy that's gone down the trend following path for as long as I have, who has assembled such an overwhelming, wide view of the subject, are you really telling me that would not be useful to you? Of course it would be. But see, this guy, whoever this guy was, he was just a troll. He's just a shithead. He didn't really want to know anything. Just an emotional, small person. Unfortunately, in the new internet age that we all live in, emotionally small people are the soup du jour. They are everywhere. And it's up to all of us to just block them out and do what we do. Because I don't do what I do to try and appease somebody like that. I try to appease the millions and millions of listens, the hundreds of thousands of books that I've sold. Those are the people that I want to appease. I want to appease the people that like my stuff. I'm not here to try and convince a crank, an idiot, a fool, that I've got an interesting way to go. But I think you would be hard-pressed to say, with the research that I've assembled, the insights that I've assembled, even if I was dead as a doornail, you would want those insights. Well, this guy wouldn't want those insights because this guy, as I have long said on this podcast, fits the archetype of the guy in his mom's basement and his tidy whities, angry at the world. God bless him. I hope he gets it straightened out. Now, coming back at you for the third week in a row, audiobook excerpts. This week, from my book, Trend Commandments. A few chapters. I think you will enjoy these. Trend Commandments did not sell as many copies as Trend Following or The Complete Turtle Trader, but it's one of my favorites. It was my effort to expand the understanding of trend following to a wider audience. And it was just fun to do. Now, you may have noticed, if you have listened for the last few weeks, I have this great audiobook narrator. His name is Joel. He actually came by way of introduction from the author Jack Schwager, who has appeared on this podcast many times and who has written perhaps the greatest selling trading book of all time, Market Wizards. Jack was kind enough to give me a few recommendations, and the gentleman that you hear narrate Trend Following, The Complete Turtle Trader, and today Trend Commandments, Joel. He's awesome. I just don't have the patience to do it. I mean, it's a whole different skill set to read for an audiobook audience. Now, I'm sure my audiobook would be fun if I read it. And one day when someone can sit me still to actually narrate for as long of a time as it takes to do, okay, I'll do it. But for the time being, please enjoy these few chapters from my audiobook for 10 Commandments.
Chapter 14. Jake. The band? The band. Reverend Cleophas James. Do you see the light? Jake. The band. Reverend Cleophas James. Do you see the light? Elwood. What light? Reverend Cleophas James. Have you seen the light? Jake. Yes, Jesus H. Tap dancing Christ, I have seen the light. Trading systems. You want to see the light? Trading coach Charles Faulkner paints a picture. No one can predict the future. If you take the would be, could be, should be out of life and look at what actually is, you have a big advantage over most human beings. What matters can be measured, so keep refining your measurements. You don't need to know when something will happen to know that it will. Prices can only move up, down, or sideways. Losses are a part of life. There is only now. Now let's get practical. Answer the following 5 questions, and you have a trend-following trading system. 1. What market do you buy or sell at any time? 2. How much of a market do you buy or sell at any time? 3. When do you buy or sell a market? 4. When do you get out of a losing position? 5. When do you get out of a winning position? Said another way, 1. What is the state of the market? 2. What is the volatility of the market? 3. What is the equity being traded? 4. What is the system or the trading orientation? 5. What is the risk aversion of the trader or client? You want to be black or white with this. You do not want gray. If you can accept that mentality, you have got it. Some might say, oh, I have a system. What he typically means is that he has a system and it advises him what to do. If he likes the advice, he'll take it, and if he doesn't like the advice, he won't take it. That is not science. You cannot test or simulate how you were feeling when you got out of bed 15 years ago when you're looking at historical simulations. If you're going to trade using a system, you must slavishly use the system and avoid discretionary overrides. You do whatever the hell the system says, no matter how smart or dumb you might think it is at that moment. Trend-following systems can vary, but principal elements remain the same. A reversal system, a very common system, has 2 modes. You are either long or short. It is always in the market. It closes one position by opening a new one in the opposite direction. Another type of system has 3 phases, adding a 3rd mode, neutral, where you are not in the market. If you are long and you get an exit signal, you don't necessarily go short automatically. You can be out of the market. Here are concrete trend-following system examples to start you on the path. You can either be long or short at any time. You enter a long position and exit a short position if the current price exceeds the highest price in the previous 100 days. You enter a short position and exit a long position if the current price drops below the lowest price in the previous 100 days. You are positioned either long or short in each market at all times, depending on the direction of the prevailing trend. You allocate risk and size your position based on each market's historical volatility. Each market receives an equal allocation of the total portfolio risk. Position sizes are normalized based on their volatility. The measure of volatility that you use is called the average true range. The size of your position you take in any given market is dependent only upon the individual market's volatility and the total account value, that is, It is independent of any other market's volatility or position in your portfolio. You buy when a market makes a new 4-week high or sell when it makes a new 4-week low. If you are long, you go short if it makes a new 4-week low. If you are short, you go long if it makes a new 4-week high. You can find more systems in my book, The Complete Turtle Trader. Those are sound trend-following systems. There are variations and nuances across the trend-following world, but when big trends happen, you need to have an approach that can get you on board, and simple often works best. The absolute key is, and this will never register with skeptics and critics, your discipline to stick with your system. That will always far outweigh whether you have the perfect set of entry and exit rules. Further, many argue that money management is far more important than your entry-exit rules. Further yet, portfolio selection is often argued to be much more important than your money management. Keep an open eye to this. Don't get rigid. Let me clarify money management. Money management, also called risk management, position sizing, and bet sizing, is crucial. It is like sex. Everyone does it, one way or another, but most do not want to talk about it, and some do it better than others. When you make a decision to buy or sell, short, you also decide at that time how many shares or contracts to buy or sell. Accept too much risk, and you increase the odds that you will go bust. Take too little risk, and you will not be rewarded sufficiently. Posit the question, I've only got a certain amount of money. How much do I trade? If you have $100,000 and you want to trade Microsoft, well, how much of your $100,000 will you trade of Microsoft on your first trade? Will you trade all $100,000? What if you're wrong? What if you're wrong in a big way and you lose your entire $100,000 on one bet? Not smart. How do you determine how much to bet or trade each time? Trend followers make small bet sizes initially. So if you start at $100,000 and you're going to risk 2%, that will be $2,000. You might say to yourself, I've got $100,000. Why am I only risking $2,000? $2,000 is nothing. That's not the point. You can't predict anything, so you have to be worried about your downside, not your upside. Risking no more than 1% per trade is a good place to start, and risking more than 5% per trade is a sure way to the poorhouse. There is a trade-off as you ponder how much to risk. Conservative betting produces conservative performance, while betting bold can lead to spectacular ruin. A bold trader placing large bets feels pressure or heat from the volatility of a portfolio. A hot portfolio keeps more at risk than does a cold one. A portfolio risking 2% on each of 5 instruments has a total heat of 10%, as does a portfolio risking 5% on each of 2 instruments. However, once you select a system and once you have your money management thought through, no less critical is your attitude. What do you really want? Why are you trading? What are your strengths and weaknesses? Do you have any emotional issues? How disciplined are you? Are you easily convinced? How confident are you in yourself? How confident are you in your system? How much risk can you handle? Those are personal questions. I can't answer them for you. Note, do yourself a favor and read the free document online titled Determining Optimal Risk by Dave Druz and Ed Sikota. It's a great starting point for taking your money management education further. A trend-following system with an edge allows a smart betting scheme to amplify profits. Chapter 57. You can't change the direction of the wind, but you can adjust your sails. Origins. Stig Ostgaard is a turtle trader, a trader covered in my second book, The Complete Turtle Trader. He graciously allowed his history of trend following to be reprinted in Trend Commandments. Although trend following has been a popular trading philosophy for many years, surprisingly little has been written about its origins and history. This is partly due, no doubt, to the scarcity of available information prior to the early 20th century, and because until about 50 years ago, trend following as a philosophy had not been completely articulated. To be sure, by the early 1950s, many trend-following methodologies were in common use, and may have been for centuries, but the underlying concept had not been fully defined or even given a name. One reason for this paucity of early information is suggested by the following part of the term trend following. The implication is one of passivity, of reaction, rather than of bold, assertive action, and human nature shows a distinct preference for the latter. Also, trend following appears to be too simple of an idea to be taken seriously. Indeed, simple ideas can take a long time to be accepted. Think of the concept of a negative number, or of zero. Simple to us, but problematic to ancestors. But, for whatever reasons, people learn easily from the past only that which the participants of the time choose to reveal, and above that, what their chroniclers found interesting enough about which to write. People know the stories of the plungers, the manipulators, and their corners, of Daniel Drew, Jay Gould, James A. Patton, and Arthur Cutten, but little of the lesser-known traders or followers sitting on the sidelines analyzing the markets, perhaps more successfully than their legendary contemporaries. Nevertheless, history is not completely in the dark. There are things to be revealed by looking back into history. Let's deconstruct the subject. Is trend following one thing or is it many? Certainly it has, at least today, many manifestations. There are breakout systems, moving average systems, volatility systems, and many others, all of which can be considered to be trend following in nature. But these are the particulars. What are the universals? What is trend following's basic nature? As a first attempt at definition, I would suggest that trend following has two natures. It is at one level a phenomenon of the human psyche, an expression of the Keynesian animal spirits that percolate from the deepest levels of man's being. This type of trend following is spontaneous, inductive, adaptive, and evolutionary, a burst of conformity to innovations in the immediate environment. At this level, the masses have always been trend followers, not only in financial matters, but also in terms of music, art, clothing, and basic worldviews. But the other level of trend following is something else entirely. This is the meta level, which sits above the tableau of material and psychological cause and effect, allowing participants to observe the behavior of the markets as a whole, and to design intelligent, premeditated responses to market action. This is the level of trend following from which we as traders should, and usually do, operate. Now, although trend following at this meta level can certainly become complex, still its essential elements can be simply stated. They are three. 1. To initiate positions based on the perceived direction of the trend. 2. To hold positions based on the perceived direction of the trend. And 3. To liquidate positions based on the perceived direction of the trend. There is also possibly a fourth thing, as suggested above. It is to do all of these things systematically, on the basis of logical relationships or mathematical formulations. But I do not think that this is an absolute requirement. It is certainly possible to be a subjective trend follower, or to combine systematic and subjective elements in a trend-following system. In fact, I believe that some great traders did indeed include subjective elements in their methodologies. Here, however, I will focus on the systematic aspect. And here again, the systematic nature of trend following can be simply stated. Generally, though not invariably, trend following systems look for their implementation only at the movement of prices. The basic perception is that if a market's price is going to make an exceptional move in one direction or another, it will first make a moderate move in that direction, leading to the conclusion that if an initiation can be made at that moderate level, the remaining portion of the trend can be followed for a significant period of time thereafter and liquidated at a profit. This scenario is not always expected to be true, of course, but if it is true often enough, and to a significant degree enough, then it may lead to profitable trading in the long run. As much as people can associate trend following with human nature, no one knows who the first trend followers were. If there is no known beginning, one is created. You can say something about a part of trend following. Specifically of the three elements of trend following mentioned above, initiation, holding, and liquidation, it is the middle part, staying with the trend, that has had a reasonably long pedigree. A number of the speculators and plungers of the past, when asked about their trading strategies, said that they held on to their positions as long as possible, i.e., they stayed with the trend. As one example, consider the economist and trader David Ricardo, who flourished in the London markets from the 1790s until about 1818. A large trader in consols, bonds, and stocks, he accumulated a large fortune from his speculations, which afforded him the leisure to focus on his primary interest in life, economics. Exactly what his methodologies were is not known, but it is to him that one of the most famous sayings in all of trading history is attributed: "Cut short your losses, let your profits run on." This is good advice, no doubt. It has survived to the present time and is expressed often. Still, there is no detail here, no advice on how to cut losses or how to let profits run on. And while the first part of the maxim says something about some liquidations, nothing is said about initiations. The ending part, however, is a clear exposition of a central tenet of trend-following philosophy. As long as the trade is going your way, don't get out. For another example, move forward a century and west to another continent. Here is a quotation from the famous grain trader of the Chicago pits, Arthur W. Cutton. "Most of my success has been due to my hanging on while my profits mounted. There is the big secret. Do with it what you will." Again, Cutton is saying, stay with the trend. For a third and final example, let us introduce Jesse Livermore, a very central figure in the history of trend following, about whom more will be said later. Here is a significant quote from him. "The big money is not in the individual fluctuations, but in the main movements. That is, not in reading the tape, but in sizing up the entire market and its trend." This last quote is from Edwin Lefebvre's Reminiscences of a Stock Operator, a series of articles from the Saturday Evening Post in 1922 to 1923, reprinted in book form many times. Although the speaker is stated to be Larry Livingston, it is generally agreed, based on known biographical information, that Lefebvre's interviewee was Jesse Livermore. The quotation, in turn, is Livermore's interpretation of an oft-repeated statement made by Old Partridge, a brokerage house acquaintance of Livermore's, that "it's a bull market, you know." This advice was given whenever some trader was tempted to liquidate a winning position too soon, and was not always well regarded. To Livermore, however, the advice finally sank in, yielding the analysis above and, it would seem, changing his trading style, if not permanently, at least in his periods of trading well. Old Partridge, alas, though people would like to know a lot more about him, will remain a mystery. How did he initiate his positions? How did he liquidate? No one will probably ever know. Prior to the mid-19th century, speculation seems to have been largely the province of the elite and a small coterie of early but still semi-elite trend followers. The larger public's participation was primarily as trend followers in the lower sense, taking part in one or another of the bubbles that permeated the financial scene from time to time, helping to precipitate the panics that occurred regularly during the period. But the next half-century and beyond saw the growth of a much larger pool of market participants, as well as some fundamental changes in thinking and procedures. According to William Fowler, in his book 10 Years in Wall Street, written in 1870, the key year was 1862, when began the greatest era of speculation the world has ever seen, while Uncle Sam's presses were printing greenbacks by the million. To be sure, some price movements in stocks and commodities during this era were breathtaking. In addition to the grain corners previously mentioned, there was the gold pool of 1869, as well as regular bull runs in numerous railroad stocks. The importance of Fowler to knowledge is that he was not just a writer, he was a participant. He knew the major traders of the day personally and participated in many of the market movements of the day himself. Finally, there is an extensive and meaningful narrative concerning speculation and the workings of the markets during a very formative period. Significantly, none of these writers records the use of any meaningful systematic trend-following methodology, although Fowler does give an example of Pat Hearn, who added to his position every time the price of his stock went up by 1%, and sold out entirely when it went down 1%. Henry Clews, in 28 Years, suggests a very primitive form of trend following, advising young traders to watch the behavior of the old retired operators who, away from the hustle and bustle, and after many, many years of experience, finally imbued with wisdom, leave their homes only a few times a year to make their appearances on the street, at times of market euphoria to sell and in panics to buy. I say to the young speculators, therefore, watch the ominous visits to the street of these old men. If you only wait to see them purchase, you can hardly fail to realize handsome profits on your ventures. Good advice, perhaps. But the problem was actually greater. Rather than old men, it was the rings and pools that more often began major market moves. How could one tell when a pool had started buying, or had begun selling? These questions had no real fundamental answer, or at least none that was accessible to the average small trader in these markets. To be sure, there were newspapers, but how was one to know the truth of what was being reported? Even if there was no outright disinformation, surely the big speculators did not telegraph their intents so easily. They rather tried to hide their buying and selling. So, for the small trader, the question was a technical one, to be answered by observing who was doing the buying and selling, to whatever extent that was possible, or by watching the price action of the stock itself and the volume. And so I would argue that the technical approach to trading, including trend following, came about not by design, but by necessity. Speculation in the 19th century was, it would appear, rich in practice but poor in theory. What was needed was an approach that could step back from the fray, observe the actions of the marketplace from an objective distance, and contemplate the nature of price fluctuations and swings over the period of days, months, and years. Were there meaningful patterns hiding in the ebb and flow of prices? Could knowledge of these patterns be the basis for trading the markets? Was there a theory that might provide structural, systematic underpinnings for a true trend-following model? In fact, such a model was being developed, if incompletely, as the century was drawing to a close. The model was called Dow theory, based on the concepts originated by Charles H. Dow in a series of articles in the Wall Street Journal between 1899 and 1902, expanded upon by William Hamilton between 1903 and 1929, and refined by Robert Rea in 1932. Inasmuch as Dow theory defines a bull market as a series of higher highs and a bear market as a series of lower lows, the rudiments of a trend-following strategy become apparent. One buys on the breakout of an old high and sells on the breakout of an old low. Of course, there are further rules dealing with confirmation and volume, but as a bare-bones system, the above will suffice, recognizing, of course, that the methodology can be applied to individual equities and commodities as well as averages. The Dow theory is, I believe, the earliest modern expression of an objective trend-following system, inasmuch as it defines precisely, as long as one can define precisely, what constitutes a meaningful high or low, the entry and exit levels for trend-following trades. Further, the methodology can be generalized and parameterized. Different levels of breakouts can be used, moving averages of prices can be used, etc. Dow theory is certainly the grandfather of trend-following methodologies. Indeed, one can argue that subsequent methodologies are mere refinements of it. Dow theory itself is not very mathematical. Rather, it makes logical observations about current and past prices to determine the direction of the market. This innumeracy is not surprising, since the theory was developed long before the advent of the computer. Nor is it surprising that the earliest offshoots of Dow theory continued in this observational, structural mode of analysis. Robert Prechter, for example, states that R.N. Elliott developed his wave methodology through contemplation of Dow theory. Richard W. Schebecker, Robert D. Edwards, and John McGee also recognized Dow theory as seminal to their thinking, with Edwards and McGee's book Technical Analysis of Stock Trends, for example, devoting 3 chapters to the subject. Indeed, Technical Analysis of Stock Trends, first printed in 1948, as well as its predecessors, Schebecker's Technical Analysis and Stock Market Profits from 1932 and Profits in the Stock Market by Harold M. Gartley in 1935, are milestones in the development of trend-following methodology. Given the focus in these books on technical patterns, such as flags, pennants, triangles, head and shoulders patterns, etc., it may seem peculiar to associate these books with trend following, but the point behind being able to distinguish such patterns is precisely to recognize signals for trend beginnings, continuations, and ends. To quote from Edwards, "Profits are made by capitalizing on up or down trends, by following them until they are reversed." Aha! The terms trends and following, separated by only the space of a word, suggestive of an underlying trading philosophy supporting the myriad of details. The second book, by William D. Gann, titled Truth of the Stock Tape, first published in 1923, also emphasizes the trend. The way to make money is to determine the trend and then follow it. Indeed, the focus in this book and other works of Gann's that followed was, in one way or another, to take trades in the direction of the market's trend. Perhaps to the surprise of some, Truth of the Stock Tape is a very conventional work, given Gann's later reputation for esotericism and astrology. The third book was Richard D. Wyckoff's Studies in Tape Reading, published in 1910. Significantly, Wyckoff uses the term follow the trend, albeit in a short-term, day trading context, when discussing one Jacob Field, prince of the floor traders, but he does not follow through with a philosophy or description. A few years later, however, Wyckoff was more decisively on the side of trend following, actually publishing a newsletter titled The Trend Letter. In a similar vein, in a later work, Wyckoff uses an interesting metaphor for trend following. A small trader should be a hitchhiker. But with respect to using charts as a means for profitably trading the markets, Wyckoff was skeptical. Let anyone who thinks he can make money following a figure chart or any other kind of chart have a friend prepare it, keeping secret the name of the stock and the period covered. Then put down on paper a positive set of rules which are to be strictly adhered to, so that there can be no guesswork. Each situation will then call for a certain play and no deviation is to be allowed. Cover up with a sheet of paper all but the beginning of the chart, gradually sliding the paper to the right as you progress. Record each order and execution, just as if actually trading. Put Rollo tape down as coppering every trade, and when done, send him a check for what you have lost. Of course, the methodology suggested by Wyckoff can now routinely be done on an iterative basis by computer. Not one, but millions of tests can be done with a rapidity that would have astonished Wyckoff. But would his judgment have changed? Possibly, since many years later, Wyckoff was using charts to draw trend lines, or as he called them, supply lines and demand lines, depending upon whether these lines connected high or low points. Let us get back to practice again and return to Jesse Livermore, who communicated much about his trading, either through Lefebvre's articles or through a book he wrote himself in 1940, How to Trade in Stocks. The early Livermore can be considered to have been at least partially a trend follower, inasmuch as he began his trading program in a small way at first, only adding to his line if the market went in his direction, and abandoning it otherwise, essentially the advice of Dixon Watts in 1891. He was also apparently a breakout trader, at one point describing a stock that was bouncing back and forth between two price levels, but observing that eventually either buying or selling would become stronger, and the price will break through the old barrier. This breakout, then, would define the line of least resistance. Later he says, "Well, when the price line of least resistance is established, I follow it." Going forward to 1940, Livermore can more definitely be considered to have been a trend follower in that, in How to Trade in Stocks, he advocated the use of specific buy and sell signals based on his analysis of the perceived trend. At one point, Livermore uses the term following the trend directly. It may surprise many to know that in my method of trading, when I see by my records that an upward trend is in progress, I become a buyer as soon as a stock makes a new high on its movement, after having had a normal reaction. The same applies whenever I take the short side. Why? Because I am following the trend at the time. My records signal me to go ahead. Note that the verb follow has become the present participle following, an important conceptual necessity, though not the final one, I believe, in solidifying the idea of trend following as a continuing or recurring action. Central to Livermore's philosophy was the recording of pivotal points, or intermediate highs and lows. These pivotal points were in part the same thing as Dow theory intermediate highs and lows, or Edwards and McGee's basing points. Initiation and liquidation signals were based on significant movement away from these pivotal points, either 3 or 6 points, depending upon the type of rally or reaction that was being considered for a stock selling above $30. Thus, Livermore's formula was not a breakout system nor a trendline system, but rather a type of filter rule, though a bit more complicated than the typically tested sort. The parameters used were arbitrary, but according to Livermore, based on much experience. Today, you can optimize parameters by computer to save time. Livermore's method certainly has some appeal, but one cannot help thinking that it might have been better understood and traded if it were chart-based. But Livermore was not a chartist. Personally, charts have never appealed to me. I think they are altogether too confusing. In addition to the work of Edwards, McGee, Livermore, and the others, the 1930s and 1940s saw several other advances relating to the theory and evidence for trend following. One of the more interesting studies came from the Cowles Commission for Economic Research, now the Cowles Foundation at Yale University, in 1937. Written by Alfred Cowles III, founder of the institution, and Herbert E. Jones, this study investigated the probabilities of sequences of rises and falls in stock market prices over several time horizons, ranging from 20 minutes to 7 months. Its conclusion was that, yes, there was a tendency for the market to continue in the same direction as the period before. In short, there was a serial correlation, at least from one period to the next. There was trendiness, and some justification for the use of trading methodologies that might today be called trend following. In summary, the study states, this evidence of structure in stock prices suggests alluring possibilities in the way of forecasting. In fact, many professional speculators, including in particular exponents of the so-called Dow theory, widely publicized by popular financial journals, have adopted systems based in the main on the principle that it is advantageous to swim with the tide. Also worthy of note was a 1949 article in Fortune, Fashions in Forecasting, by Alfred Winslow Jones. Yes, that Alfred Winslow Jones, originator of the hedge fund concept and founder of the first hedge fund. In the article, Jones analyzes many of the then-current stock forecasting techniques, such as Mansfield-Mills buying and selling curves, Dow theory, and other methods having trend-following characteristics. His explanation of trend following revolves around acceptance of the undoubted fact of momentum in psychological trends. The process he describes sounds something like George Soros's reflexivity. Thus, a movement in the stock price once underway generates unrealistic optimism or pessimism, so that the trend of prices then carries through and beyond some point of central value. After that, turned by profit-takers or bargain hunters, with the basic forces of supply and demand altered, the market pendulum starts back, and passes again through and beyond a point of reasonable value, wherever it may be. Therefore, the chances are worth considering that once a trend has reversed itself to some measured extent, as determined by the Dow theory, or the penetration of a moving average or trend line, the new trend will continue far enough to make it worth following. It is notable that Jones uses the exact terms trend followers and trend following in his article, but the meaning of the words perhaps differs from its usage today. For example, when he states that what Mills and Lowry have are still trend-following tools, with all their advantages and limitations, he seems to mean something more like trend lagging, such as when a moving average turns higher after a trend has already begun. In other words, trend following was not yet a fully formed concept. Trend was not yet a noun adjunct, nor following a gerund. The individual who finally made the connection was perhaps William Dunnigan, a trader, technical analyst, and writer who ran a business cycle forecasting company in Palo Alto, California in the 1950s. Dunnigan had many books and other publications to his credit, beginning with the academic Forecasting the Monthly Movement of Stock Prices in 1930, and following with a more technically oriented, mimeographed publication called Trading with the Trend in 1934, to name two. His major works, however, came out in the early and mid-1950s. Dunnigan is perhaps best known today for his thrust methodologies and one-way system, but his overall market perceptions were broad and deep. He had a knack for verbal innovation, including the invention of terms such as trap forecasting and continuous forecasting, used to distinguish between those trades designed to capture quick profits, catching the market in a trap, and those with an indefinite duration, whose exit levels were determined on a day-to-day basis, depending on market action. Starting with these perceptions, the transition to trend following is not an arduous one, for if a market is trapped into a directional commitment at the point of, say, a breakout, i.e. it generates a signal, then continuous forecasting takes over until the next trap, to liquidate or perhaps reverse, is signaled. But if that is the model, then is the forecasting part of the formulation really necessary? Is not the process rather one of monitoring the market for the occurrence of the next trap, and then, when it occurs, acting upon it? Ultimately, in his 1954 work, New Blueprints for Gains in Stocks and Grains, that is what Dunnigan concluded, giving us some of the earliest articulated insights into the philosophy behind trend following. We think that forecasting should be thought of in the light of measuring the direction of today's trend, and then turning to the law of inertia, momentum, for assurance that probabilities favor the continuation of that trend for an unknown period of time into the future. This is trend following, and it does not require us to don the garment of the mystic and look into the crystal balls of the future. And again, let us believe that it is possible to profit through economic changes by following today's trend, as it is revealed statistically day by day, week by week, or month by month. In doing this, we should entertain no preconceived notions as to whether business is going to boom or bust, or whether the Dow Jones Industrial Average is going to 500 or 50. We will merely chart our course and steer our ship in the direction of the prevailing wind. When the economic weather changes, we will change our course with it and will not try to forecast the future time or place at which the wind will change. William Dunnigan today remains an underrated trading researcher, although he was highly, if not widely regarded in his day, even by academic economists. Elmer Clark Bratt, for example, refers to Dunnigan's Trading with the Trend in his Business Cycles and Forecasting, one of the premier economics textbooks of his day. Intermediate movements in the stock market do not last any stated length of time, so we never know just when a rally or a reaction will take place. What has been called trading with a trend by Dunnigan appears to be the only important forecasting principle which can be derived. Next in line among the pioneers of trend following was the much better known Richard Donchian, whose article Trend Following Methods in Commodity Price Analysis appeared in the Commodity Yearbook of 1957. Donchian's article was written in a confident, matter-of-fact manner, suggesting that he had a long, intimate knowledge of the principles about which he wrote, particularly the use of moving averages and swing trading, both developed in the article as examples of trend-following methodology. Like Dunnigan, Donchian discussed more than just the trading systems themselves. He also discussed the philosophy behind them. The comments he made about trend following still hold true. Every good trend-following method should automatically limit the loss on any position, long or short, without limiting the gain. Whenever a trend, once established, reverses quickly, there is always a point, not far above or below the extreme reached prior to the reversal, at which evidence of a trend in the opposite direction is given. At that point, any position held in the direction of the original trend should be reversed, or at least closed out, at a limited loss. Profits are not limited because whenever a trend, once established, continues in a sustained fashion without giving any evidence of trend reversal, the trend-following principle requires that a market position be maintained as long as the trend continues. Richard Donchian, as most traders are aware, did much more than write about trend following. He was also a broker, analyst, and trader, who most significantly was the founder of the first publicly managed futures fund, the Moving Average-based Futures Inc., in 1948. Starting in 1960, he began writing a weekly commodity trend timing letter, based on one of his better-known trend-following systems, the 520 moving average method, thereby creating a documented, decades-long performance record for his trading methodology. Further, Donchian was an innovator in advancing an idea that is now the norm among large futures trading entities everywhere: the concept of trading many markets at the same time in a portfolio. When I first got into commodities, no one was interested in a diversified approach. There were cocoa men, cotton men, grain men. They were worlds apart. I was also the first who decided to look at all commodities together. Nobody before had looked at the whole picture and had taken a diversified position with the idea of cutting losses short and going with a trend. And so, with Dunnigan and Donchian, the story comes to an end. Although these two were by no means the first trend followers, nor surely the last, they were truly a watershed in the history of trend following. While many of the ideas that preceded theirs were trend following in nature, they were largely inchoate, with an unstated or incomplete underlying philosophy. Dunnigan and Donchian, however, articulated this philosophy, indeed called it trend following, and thereby laid a foundation upon which later methodologies could comfortably rest. The narrative continues, of course, but since it has already been well and amply covered, I will stop at this point. Suffice it to say, however, that everyone remains under the influence of these pioneers of trend following, whether people know it or not. You can read an unabridged version of Stig Ostgaard's On the Nature and Origins of Trend Following at www.trendfollowing.com/resources. It's quite true what philosophy says, that life must be understood backwards. But one then forgets the other principle, that it must be lived forwards, a principle which, the more one thinks it through, precisely leads to the conclusion that life in time can never be properly understood, just because no moment can acquire the complete stillness needed to orient oneself backward. Chapter 58. Carl Sagan didn't want to believe. He wanted to know. Cheat sheet. Author Seth Godin said it well. Golf is not safe. My grandfather died playing golf. Speaking up is not safe. People might be offended. Innovation is not safe. You'll fail, perhaps badly. Now that we've got that out of the way, what are you going to do about it? Hide? Crouch in a corner and work as hard as you can to fit in? That's not safe either. Might as well do something that matters instead. I live and breathe my research firm. Reaching and teaching people my lessons is rewarding. Take advantage of my work, and you will either make or save a great deal of money. For your associates, friends, and family, some bullet point ways to describe and explain systematic trend-following trading. Profit in up and down markets. Trend following doesn't swear an allegiance to a bull or bear market. It follows trends to the end. No matter how ridiculous trends might appear early and no matter how insanely extended they might appear at the end, follow trends. Why? They always go farther than anyone expects. Ignore momentum at your peril. No more buy and hold, analysts, or news. Trend-following decision-making doesn't involve discretion, guesses, gut feelings, or hunches. It's not day trading or buy and hope. It doesn't involve passive indexing, in and out trading, or fundamental analysis. No more 24-hour news cycles, daily turbulence, or sensational hype. No black boxes or magic formulas either. Let go of the holy grails. No prediction. Trends exist everywhere, always coming and always going. Markets are no different. They trend up and down. That said, no one can predict a market trend. You can only react to one. Trend following never anticipates the beginning or end of a trend. It only acts when the trend changes. There is no need to figure out why a market is trending. Just follow it. You don't need to understand electricity to use it. The big money of letting profits run. Trend following at its best aims to compound absolute returns. It doesn't shoot for average. The goal is to make the knock-your-socks-off returns, not passbook savings interest. Trend following also has the unique ability to lie and wait for targets of opportunity. That means making a killing on unpredictable surprises. Risk management is top priority. Trend following always has defined exit protocols to control injury to your account. Stop losses and proper leverage usage are standard practice. Trend following also has low to negative correlations with most other investment opportunities. Takes advantage of mass psychology. Trend following takes advantage of panicky sheep behavior. Strict discipline minimizes behavioral biases. It solves the eagerness to realize gains and reluctance to crystallize losses. Too many people believe what pleases them. Most behaviors are simply driven by the impulsive moment of now. Trend following wins because of that. Scientific approach to trading. Trend following doesn't require a belief, but rather it relies on unwavering scientific principles. It has a defined edge, just like the MIT card-counting team that beat Vegas casinos. Be the casino, not the hapless player. Trend following uses rigid rules rooted in numbers. Think process, not outcome. Remember, frequency of correctness is not the issue. The magnitude of correctness matters. Winning percentage means zilch. Strong historical performance in crisis periods. Trend following is adaptable to differing climates and environments, performing best during periods of rising volatility and uncertainty. The unknown will happen again. Are you ready? You have to be able to ride the bucking bronco, ride out the storm, and stay alive. No traditional diversification. Trend following is not restricted to any single market or instrument. A focus on price action allows trend following to be applied to an exceptionally large variety of markets. Price is the one thing that all markets have in common. A trend trading system for Treasury bonds should also work on the euro and stocks. Trend following is robust. No government reliance. Forget Social Security, bailouts, stimulus plans, and roads to nowhere. Those won't help you to make money. They only help you lose. When the Fed puts on or takes off the training wheels, read rate manipulation, will you be ready to mint cash? Or will you sit there and just take it again? If your portfolio is grounded in sound principles, you can win no matter what happens. Chapter 59. Question: do you expect to make money in both good markets and bad? Answer: there are not good or bad markets. There are up or down markets. Quick commandments. The great trend-following traders have been motivated by possibility and opportunity, unlike crowds of panicky sheep, unwilling or unable to leave the herd. Great trend traders seek options, experiences, choices, and paths. They never quit or allow themselves to be muddled by the latest fashion. In that spirit, these are some of my favorite money-making gems pulled from the historical wisdom of trend trading pioneers Richard Donchian, William Dunnigan, Amos Hofstetter, Jesse Livermore, Roy Longstreet, and Dixon Watts. Don't fight the tape. Like sharp instruments and strong spirits, leverage confers many benefits, but only when used with care. Limit losses and ride profits irrespective of all other rules. Of all the speculative blunders, there are few greater than trying to average a losing game. Always sell what shows you a loss and keep what shows you a profit. You can't force a market into giving you something it doesn't have to give. Talk is cheap, and rumors are even cheaper. Courage in a speculator is merely the confidence to act on the decision of his mind. A loss never bothers me after I take it, but being wrong, not taking the loss, that is what does the damage to the pocketbook and to the soul. The trend is evident to a man who has an open mind and reasonably clear sight. In a narrow market, when price moves within a narrow range, the thing to do is to watch the market, read the tape to determine the limits of prices, and make up your mind that you will not take an interest until the price breaks through the limit in either direction. Watch the market with one objective, to determine the direction of price tendency. Prices, like everything else, move along the line of least resistance. It cost me $1 million to learn that the dangerous enemy to a trader is the susceptibility to the urging of magnetic personality combined with a brilliant mind. Have a profit? Forget it. Have a loss? Forget it even quicker. It was never my thinking that made the big money for me. It was my sitting tight. There is only one side to the stock market, and it is not the bull side or the bear side, but the right side. If you don't know what's going on, don't do anything. Markets are never wrong, opinions often are. Don't be too curious about the reasons behind moves. The smarter you are, the longer it takes. When time is up, markets will reverse. Don't expect the tape to be a lecturer. It's enough to see that something is wrong. Don't imagine that a market that once sold at 150 is cheap at 130. A man does not swear eternal allegiance to either the bear or bull side. People believe what it pleases them to believe. Trend followers plan when they will get out before they ever get in. Know every day what your portfolio is worth. Calculate what your risks are on any given day for all positions. Controlling risk is not the same thing as avoiding risk. If managing risk is an integral part of your philosophy, when your risk level goes up or down, you simply adjust. Buy market strength and sell market weakness. Keep a positive attitude no matter how much you lose. Don't take the market home. Dream big dreams and think tall. Very few people set goals too high. A man becomes what he thinks about all day long. In the world of money, in a world shaped by human behavior, nobody has the foggiest notion of what will happen in the future. Mark that word. Nobody. When the ship starts to sink, don't pray. Jump. Assimilate into your very bones a set of trading rules that works for you. Thou shalt not trade against the trend, up or down. There is nothing new on Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again. Sell when you can, not when you have to. An ability to shift on a dime is critical when shifting time comes. A common deception, self-deception. Fools try to prove that they are right. Wise men try to find when they are wrong. All see, few observe, Fewer still compare. The foolishness of the many is the opportunity of the few. The man who conforms never transforms. When you begin to doubt, begin to get out. Make-believe is a game society plays as well as children. Some men are alive after they are dead, others are dead while still alive. It's not about how much you can make, but how much you can lose. The unpardonable sin, not to make money. Lastly, consider William Worthington Fowler's wisdom circa 1870. To the merchant and banker, it is a financial center, collecting and distributing money, regulating the exchanges of a continent, and striking balances of trade with London and Frankfurt. To the outside observer and novice, it is a kind of workshop, thronged by cunning artisans who work in precious metals, where vessels of gold and silver are wrought or made to shine with fresh luster, or where old china is fire-gilt as good as new. The moralist and philosopher look upon it as a gambling den, a cage of unclean birds, an abomination where men drive a horrible trade, fattening and battening on the substance of their friends and neighbors, or perhaps a kind of modern Colosseum, where gladiatorial combats are joined, and bulls, bears, and other ferocious beasts gore and tear each other for public amusement. The brokers regard it as a place of business where, in mercantile parlance, they may ply a legitimate trade, buying and selling for others on commission. To the speculators, it is a caravanserai, where they may load or unload their camels and drive them away betimes to some pleasant oasis. To the financial commanders, it is an arsenal in which their arms and chariots are stored, the stronghold to be defended or besieged, the field for strategy, battles, and plunder.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.